All right, guten Morgen. Is that Vivaldi? Let me turn off the music. Brup, brup. All right, good morning. Let me remind you that trading is risky. And let's say it right. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. All right, let's go through our routine. It's good to have a routine. It keeps you safe. It keeps you focused, keeps you smart. Regiment. Study Ernest Shackleton. He has an amazing story to tell. And what saved him and the boys was regiment and routine. There were no ladies.
Good morning. Let us get you up to speed. Current market sentiment is decisively risk-off for today's session, marking a sharp divergence from the broader monthly trend which had remained optimistic until now. This sudden pivot is being driven by geopolitical instability, which has pushed the U.S. 10-year yield higher as inflation fears resurface, simultaneously weighing on major currency pairs like EUR-USD and GBP-USD. 1. Oil prices are jumping over 5% this morning after news that a major deal with Iran was called off, sparking fears of a wider Middle East conflict. This has hit European stocks hard, with the CAC 40 falling 2% on concerns that higher energy costs will keep interest rates elevated. U.S. mortgage applications also showed weakness, falling 2.2% in the most recent weekly data. While gold is usually a safe haven, it is actually trading lower today as the surge in the U.S. dollar and rising treasury yields weigh on the metal. Biggest movers right now, platinum is down. VIX, Brent crude oil, WTI crude oil, and corn are up.
See, I'm so glad he said that gold is usually a safe haven, but it's now trading lower and blah blah blah. So when Aiden says that, he's getting it from the headline radar, and the headline radar is what reporters are writing about current market sentiment. And he knows that that's not true, but the reporter that wrote it doesn't know. Yes, I would agree in general, gold would be considered a safe haven. But over the last 90 days, and actually longer than 90 days, but we only care about the last 90 days, it has not behaved that way. We track real-time correlation coefficients, and it's not a risk-off safe haven. It has a positive Pearson correlation coefficient with the VIX. Or not VIX, sorry, with risk. So while gold is usually a safe haven, that is generally true over the last 10 years, 20 years, 30 years, 40 years, 50 years. But over the last 100 days, that's not true. And so that reporter's like, oh, well, oh my God, it's trading lower today. It's what they're admitting is they just don't know. Their assumptions are incorrect about gold and its relationship to risk. It's incorrect. Now, it's a correct rule of thumb. But rules of thumb do not make you successful. Being above average makes you successful. So anyway, so we know that this part here is untrue, but this is just him doing sentiment. Remember, this is part of the sentiment radar. It's what is being written and what traders are being told. Doesn't mean it's true. Ooh, ooh, ooh. Right? A little Milli Vanilli in the morning. So anyways, hey, Veritas, the truth through knowledge. This makes you Illuminati. Anyways, what else is going on? Whoa, VIX way up. Dollar up. Okay, that's risk off. Gold down, that's risk off, and all of this is normal. So it should not be a surprise. Yesterday, inside of TradeRs, we did a webinar and we focused on crypto and energy and metals. And holy smokes, eh? Oil is up 5% since then. Somebody, we won't say who, said, oh, oil, ooh. I'm like, hey, why are you freaking out? It's the thing. So address the risk. If it's the thing moving, address the risk. If it's too much volatility, lower your lot size. If it's too expensive, lower your lot size. But ignore it? No, that's not how we roll. Address the opportunity or threat head on.
U.S. dollar. Worse risks skewed to cuts. Commerzbank. Trump says interim accord to end war is over after Iranian strikes.
XRP extends downturn as ETF flows. On-chain metrics and technicals weaken.
Oil. Conflict-driven volatility and positioning. BNY.
Global yields spike as Trump expresses pessimism over U.S.-Iran deal.
Swiss franc holds losses as fresh US-Iran tensions support the US dollar. British pound slumps against US dollar as risky assets turn fragile. Luxembourg inflation eases to 4-month low.
Polish zloty. Dovish MBP stance weighs on PLN. ING. Australian dollar weakens on renewed Iran tensions ahead of Fed minutes.
Cool. Hey, do you trade zloty? What do you think of the zloty? You're like, I don't think much about the zloty at all. There's the trend. There's the trend kick off the role reversal, guys. Silver. Okay, our plan from 2 weeks ago. Back below the central pivot. Yeah, I wanted to... Oops. Here we go. Zloty. Where is the zloty? Oh, there we go. Versus Europe, sure. It's got a little bit of a carry, huh? It's not a bad little carry. If you're looking for carry, it's not too bad. Just want to point that out. Probably not against the dollar, just because the spread differential is quite different. Yeah, it's negative on both sides. Yeah, but against Europe, there's a nice little carry if you're Euro zloty short. I mean, we could look at it. Why not? Okay. The question is, will this ever turn bearish again? And it kind of looks toppish, doesn't it? Okay, the bullish target for the year is 4.35. But R1, annual R1 is 4.2975. Essentially right exactly where we are now. So if you were going to do a carry trade, the ultimate carry trade, and you can see I did this several months ago, like what if it rolled over here? If it ever did, even if it just moved sideways like it did way over here, that's what you actually want with the carry trade. You love the sideways action because having it drop too fast means you're making way too much. You're making too many pips, and it scares you out of the carry trade. You make too many pips, and it scares you out of the trade. Moving sideways, you're not really making pips, but you're collecting swap every day. Oh, and I'm a big fan of swap. Huh? My whole pension fund is based on swap, basically. Well, dividends, and it's not really dividends. It's but anyways, it's all income. And I love income. Anyways, let's go back to the analytical platform. You don't want to go shopping while you're hungry. And what I mean by that is you can just burn through a bunch of charts and find something to do. Well, Jim, they call it a dividend, but it's really an income distribution. Yeah. But whatever. Call it whatever you want. Call it whatever you want, as long as the SEC likes it. I love you, SEC. It's money. Well, and more than money, because there's different forms of money, isn't there? But cash flow is even better. But anyways, look, things are no so good. Okay. Ouch. That's all I can say. So, risk off. This is what is happening. Having measured so many different aspects. So, the put-call ratio, the VIX, the 10-year yield, the NASDAQ, the Dow Jones, Bitcoin, gold, oil, 210 spread, Japanese stock market, investment-grade bonds, U.S. dollar, 2-year yield, S&P 500, German stock market, junk bonds. It's risk off. So you're a bit defensive today, and it's also very normal, right? Yeah, well, Jim says, risk has really moved in the last hour. Well, the market's opening, right? And more of the assets that we're tracking on the daily basis are starting to move, right? Meeting minutes coming out today at 10:30. We got our oil inventories. Yeah, that's important. Oh, for sure. Because if we're running out of oil and the war is back on again, there's an extra level of sensitivity, right? Prices will be even more sensitive. Elasticity. Okay. There's a change based on sentiment. Like if you think about duration, which is actually the sensitivity to changes in interest rates, it's actually, I mean, it's kind of related to time because it's magnified over time. Okay. JK's like, hey, man. Well, yeah, on the oil trade, right? Yeah. Yeah. Yeah, well, what did I say? John, it was like, what, 12 hours ago, right? And I'm like, just lower your lot size. But be ready for the opportunity, right? Yeah. Cool. Yeah. Asset asset selection is critically important this time of year. And for that, we need the data. But anyway, so duration, most people say, oh, well, that's the study of changes of interest rates over time. Kinda. It's the sensitivity to the change in interest rates, and that is magnified over time. Well, in this case, like, what's the word to say? Obviously, oil prices and oil inventories are related, but in this situation, that relationship is going to be um, more because of the change in sentiment relative to geopolitics. Yeah. So there's a little bit of that going on right now. We're also, over the last several days, you've probably noticed we're doing a lot of import export data because it's the governments that are calculating their GDP, right? C plus I plus G plus X minus M. So you're getting a lot of X minus M data. We had some 2 days ago. We had some yesterday. We have some coming out today and tomorrow as each of these agencies report. So I think import export or balance of trade is the Commerce Department. Yeah, and we're plugged into them. And so anyways, we're seeing this out of Europe and Australia and the United States. And yeah. Oil's way up, and it's supposed to be down this time of year. That's why it's over here. We have a negative score, which would be what you would think if everything was normal. And I'm not just talking about geopolitics. I'm talking about 20 years of data about the direction and shape and steepness of price action in oil over the last 20 years for this time of year, and plus all the different macroeconomics and all of that. We go in there and we're like, yeah, we should be a little bearish, but it's way bullish today, unexpected, because that's, again, an exogenous supply shock. It's closer to a black swan. A threat to supplies. And in fact, it's not just a threat to supplies. We have now diminished our supplies by revoking Iran's ability to sell oil globally. And then the Straits of Hormuz being blocked. So let's just say, once again, our supply of oil over the last 48 hours has dropped 20% again. So prices are up. And this is what John King is talking about. Our conversation yesterday is like, hey, look, geopolitics have changed. Things have just changed. Specifically over what I just talked about. So that might be the opportunity. And if you don't trade oil, drop your lot size because, yeah, it is more expensive. And yeah, it is volatile. Okay, euro dollar moves 5% a month, maybe. Oil moved 5% last night. Yeah. Yes, it did. And we had that all set up analytically. But when we get these numbers, where crude oil is usually a negative number. That's why we have this, by the way. this isn't necessarily what oil is doing. It's the logical quantitative model for what we should think of oil in the second week of July. And to get to that conclusion, okay, we do our analysis. It's down here. Dude, look at all the data that it's insane how much data we have. Absolutely insane how much data we have. But looking at global economics, the fundamentals, okay, and the charts, because trend and momentum, it comes from the charts, and global growth projections and all these different things, we're slightly bearish, and yet, boom, this big spike against the technical charts. Yeah, well, this is not technical. Okay, this is not a technical move. Bum, 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 bum. Mm. Hang on, I want to ask Aiden something. Aiden. Hang on, sorry. Sorry. Just want to document a couple of things. Bum, 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 bum. Just hang on, hang on, calm down. Okay. Ba, 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 ba. See, I love going through, even though we've done this, like what day is it today? Wednesday? I mean, we've gone through the COT report on Monday afternoon, or maybe it was even just yesterday because of the delay the delay due to the US holiday. But I still love to regroup my brain. Regroup it, like realign the satellite every morning. Adjust my watch to just make sure everything is perfect. And I Now that I just adjusted my watch, I realize there's water in it because the little crown is open. No. Anyways, yeah. So, even though I should just know this, I like to review it. What can I say? So, dollar is strong right now. A week ago, before the 4th of July holiday, maybe it was Canada Day, we were talking about things like euro dollar down in the month. We just looked at it, and that'd be normal. Dollar CAD up was another one. Okay. And I want to just make sure you're aware, like we have these conversations, but they're supposed to be more than conversations. They're supposed to be strategy sessions, right? So we wake up in the morning and typically we want to sell Aussie dollar. We want to buy dollar CAD. We're probably interested in Kiwi dollar short. We were very interested in selling yen pairs, so buying the yen. And these are just general assumptions from our research, not rules of thumb, from our research. And then this time of year, because we very often lack macroeconomic trends, we got to confirm or deny our general assumptions based on historical norms to reduce some of our risk by not just randomly finding something in the trade. Okay? Okay? So, there's two things from this. This allows you to use confirmation bias, your confirmation bias, as a tool to lower your risk. The second thing is to say, oh, well, that's unusual because you already know what usual is. If you don't know what usual is, how can you spot some unusual activity? So, okay, we do not like the Canadian dollar. Economically, if you study the macroeconomics, it's a disaster. It's been the weakest currency for quite some time. Why is the Canadian dollar strong today? Like right now? Oil. Well, that might explain it, right? That might explain it. Now, maybe it's something completely different, but I do think that is rational. Yes. Energy, in particular, all forms of energy are up. So Brent is up 5, WTI is up 5, and CAD is up. Is that normal? Yeah, well, we have the correlation coefficient studies to say, yeah, that is probably normal. So we can go to fundamentals, correlation. Okay. So what we want to try to see here is what is related to either the Canadian dollar or to energy. Still haven't cleaned this up. This is a bit of a mess. At least we got the data. Don't be so judgy. How dare you judge me? You're like, yeah, I have every right to judge. Yeah, it's true. Girl, you know it's true. Brant. My mouse isn't working very well either. Brant. Is it going to give me a Brant? And is Brent going to show me CAD? I was trying to do CAD. It's got an Aussie index. Oh, there it is, CAD index. All right. What do we see? Is this going to work for us? Yes. Okay. Now we have facts, not assumptions. Okay, Matthias? Matthias says, CAD is up because oil is up. Well, I would assume the same thing, Matthias. But because there's no assumptions that trade ours, what we're going to do is say the dollar index, what kind of relationship does it have with WTI? Positive. Strong. Actually, we say moderate positive, but it's pretty good. It's pretty good. Yeah. There is a relationship. So over the last 90 days, okay, if WTI is down, CAD is down. If WTI is up, CAD is up. We check several times a day, and we store the analysis over 90 days. Okay, so it's very accurate to current market conditions. And so, yes, you can make that assumption. Well, it's no longer an assumption, Matthias. Okay. They're highly correlated. Would anybody prefer to just have guesses and rules of thumb? Or would you like to know how correlated they are in real time based on current market conditions? Don't answer that. It's rhetorical. Cool. Yeah. But we were interested in things like Aussie versus US dollar down, Euro versus US dollar down, Kiwi versus US dollar down. Pound we saw as being stronger than usual in current market conditions, and we were not sure about that technically, right? So we can go here, right, which shows dollar Swissy up, which is one of our assumptions in July. USD yen up. Well, this one's a little more bullish. I think our assumption is a little more neutral. Our assumption is Kiwi dollar down. Okay. Okay. I just updated here. Come on. What's it doing? Whoa, what's it doing? Okay. I'm going to have a conversation with Aiden. Why is he flipping the data? Oh, he's doing some work in the back end. All right. Well, that's going to make it. Euro dollar down is what we're going for. So let me just, let's just go here then. So our assumptions would be, or have been in this situation, dollar strength, USD Swissy up is your best opportunity right now. Dollar yen right now. Kiwi dollar up, pass. And look at, right? So pass. This is all right. Okay. This is moderate. I don't like the direction or this, right? Then you look here, this is a little different. And yes, CAD is strong. We normally would want, like, let's say we haven't done any analysis. All we know, let's say we haven't done analysis since yesterday, and we would assume USD CAD up. Looking at the 15-minute chart, does that look like an opportunity or a threat? Well, that's a threat, bro. a lower low after a double top. So we could, from this, also make an assumption like, oh my God, something, either the dollar's collapsing because we have awesome news, or CAD is very strong. Going back to yesterday's assumption, I think the biggest opportunity that we highlighted in yesterday afternoon's meeting is euro dollar down. Okay, it's just warming up. And look at the built-in assumptions here. Like I said, pound would be most likely, based on what has been happening over the last week or so, you would say, well, if U.S. dollar's strong today, pound has been strong generally for a while, and so they would kind of offset each other. And even though there's a big spike, look at the projection. It's showing you, even Aiden is saying, okay, there is no doubt the U.S. dollar's strong and it's crushing pound. But based on what has been happening recently, it's still unexpected because the slope of the mean is still a positive integer. Wayne, say it in trader speak. The trend is still up. On this time frame, it's still up. Now we can get that by looking further out. And the further you out go, the probably the better for you to see what direction trends are. So pound has been stronger than the US dollar over the last month. And you can see we've had a higher high, higher low, higher high, higher low. And so what would you think if you only looked at this chart? If you had no market sentiment, if you had no macroeconomics, you knew nothing about nothing except this chart. Well, you'd say, well, we're getting 2155 crossover. This market is turning bullish on a daily chart. We just had a pullback, so I'm going to buy it. Linear projection with the standard deviation calculation says best case scenario, we go to 135. That didn't. So we can get that form a little better. Okay. Yeah. So today's down move. Okay. You put into context. Okay. Neat, right? Yeah, very neat. So go back to like we have a market open. What are you trading right now? You know the reason we meet early. In fact, 8 is not even that early. You probably should have made your New York trades before this webinar even started. I want you to fully appreciate that. This should be a listening strategy session, not you actively like, okay, what did Wayne just tell me to buy something? No. If that's what you're doing, you're falling behind. You're still thinking like an amateur. You should have already done your analysis and already placed your trades before we meet. I was explaining last night in the afternoon at the market close meeting inside of Traders, we were talking about, how I like to trade gold between 6:30 and 7:30 in the morning, and then take profit around 10:30, depending on price targets and stuff. Okay, yeah. Okay. Look at gold and silver, guys. Risk off, and that is normal, and yet the reporter, and I think FX Street, because this person, I'm guessing it's the same person, in my humble opinion, has been writing opinions that I highly disagree with because I have data. And so in this case, down only confirms, it's not a surprise down. If we have a risk off scenario because of geopolitics, well, that what it has been doing, it meaning gold in that scenario, is it falls. So anyways. Yeah, so that's interesting. Now we want to take a longer term view of it as well, because the next part of the secret sauce, if as a successful trader, is you're thinking in advance. You're like, okay, let's say it falls for a day. Let's say it falls for a week. Let's say if it falls for a month. If you're a bull, those are opportunities. So now you're not thinking about whether you should buy it. You're not thinking whether you should sell it. Hey, you've been looking at red candles for 3 weeks, yeah? So what? But if you're a buyer, you're like, well, I'm going to wait for the psych level. I'm going to wait for the pivot point. I'm going to wait for the calendar, which we call seasonality, and then start building positions at the lower price because your research already tells you up. And could it be safe haven flow? Yeah, it could be. Then it's just not safe haven flow now. That's the difference between the general rule of thumb and then what is actually happening. That's why you should have the data. Okay. Does gold typically go up this time of year? I don't know. Does it? Why does gold go up? What if it was something like Christmas? Let's say around the world, gold gifts with gold in it, whether it's jewelry to computers. What if the manufacturing of these Christmas products that are going to be delivered to homes before Christmas, what if that increases the demand for gold? Do you start making, gold jewelry in July for Christmas? No, probably not, actually, huh? It's probably later. Okay. Or what if gold moved because of the purchase or sale of gold by central banks? Well, then you would need to understand their monetary policy. Like, what is the agenda? What are they trying to achieve? And how, and once you understand what they achieve, you could say, well, one opportunity could be to buy or sell gold, depending on what their goal is. To increase the value of their currency, to decrease the value of their currency. These are goals that a central bank could have, and using gold as part of that policy is right as rain. But when do central banks do it? In the summer? Well, are they on holiday? Like, what if they wait until September to buy gold? Well, then it would show up in seasonality, wouldn't it? And so you can use all that and say, well, I'm long-term long gold. Like the institutional investors. Okay? So you go to commodities and you go to gold, and the institutional market is heavily long gold, everybody. Heavily long. And they have been. In fact, even though gold has dropped more than $1,000 an ounce, I think there was no selling during that whole period by institutions. And if there was, it was very little. And in fact, last week, institutions bought more. They're buying. Let me say it again. Institutional investors so big that they're required by the government to report the buying and selling of their gold positions. They're heavily long, dramatically long. They didn't sell even though price dropped by 1,200. And in fact, they're buying more on the dip. Is this useful information to you as an amateur trader, as a retail trader? I hope so. Okay, look. There's a bit of a recovery going on. You see, this updates often. I think every day, actually several times a day. This used to actually be pointing down to closer to 3,000 than 4,000. Now remember, it's only a linear projection. It's not a price projection. It's a statistical analysis of trend. So now if you look at more recent, statistically, the more recent price action is actually pointing up. And then if you go throughout the end of the year, it says closer to September. And we could end the year at above 5,000. Actually, a lot above 5,500. If you look at our base case scenario, and maybe it's hard to see if you're watching this on the video, but you have this in TradeRs. Okay, the best case scenario is $5,872. And the timing of that is at the end of the year. Okay, yeah. To do these calculations, you need 20 years of data. That's it. Only 20 years. Cool. But right now, it is falling. It's down 6.1% this month. Okay. August doesn't look like it's going to be any better. But at some point, dollar right now is strengthening. Is that seasonal? Yeah, it's actually seasonal. But is it related to geopolitics? Yeah. Yeah. But it's only up a little bit in the last 30 days. And yes, the dollar's strong today relative to a day ago, but not that much. Despite going back to war, really, this didn't jump to 110. It actually barely budged. And one thing that you have known for several months now, that if you love gold, you should be trading silver because it's even better. It's all in the data, folks. So if you were going to have some homework, I would say, think about this. Why did I put the real yield on this page and no other? Think about it. And then you're like, well, what is the relationship? Yeah. And now you're thinking. You're not just reading, you're thinking. Okay? Having data is important. Having the data organized is important. Being able to visualize the data is important. But you actually have to do some analytics, which means thinking, analyzing. What do you think? So this should stand out. You're like, wait, this doesn't show on any other page? Well, lucky for you, I put a clue. And you're like, Wayne, I don't know the difference between headwind and tailwind. Well, you have the internet and you have artificial intelligence to Google it. Google it. But yeah. So then think about, well, what is that relationship? If the real yield was paying you 5%, what would that mean for gold? If the real yield was zero or negative, how would that impact gold and silver? Aha! Beautiful, right? I'm gonna tear you apart. Check this out. So why do I put the gold-silver ratio? And why do I say trade silver, not gold? Because it's almost statistically exactly the same, but you might find it cheaper and faster and better for retail trading because institutional investors are not buying and selling gold right now. Well, they're not. They're buying more than they're selling. Let's put it that way. But silver is much more retail. So you might find it cheaper and faster and more like trading currencies than trading against the positions of large institutional investors. So think about it this way. If the institutional investing community is long gold, then when you need to buy gold, you want to hold for longer periods, right? But what if we're in a period in which you want to sell gold? Well, you're selling gold against institutional investors that are not selling gold. So you have lost congruency with gold market sentiment. But you probably don't have that problem with silver. So you can short-term short silver, but long-term long gold. Huh? The K-shaped commodity trading strategy. I just made that up. You can tell because I stuttered. But you see? You see the importance of that? If you have the data, then you can say, oh, silver's pretty much exactly the same as gold. If gold is down 1.5%, silver's down 1.25%, practically the same, step by step. So if silver's cheaper, you get just more bang for your buck. But you don't want to trade against institutional investors, so you want to trade with them. So if gold is up, buy gold, hold it. If gold is down, sell silver. Day trade it. Genius, 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 huh? You're not just pretty, you're a genius too. So, anyways, you got your long term and your short term data. sell euro dollar, sell Kiwi dollar. Okay, sell the Nikkei. Those are your best opportunities. Isn't that nice how it breaks it down into asset class and then into magnitude and then direction? It's a lot of calculations to do this, and it's so pretty. Sorry, hang on. Cool. So, anyways, boy, I've been stayed up late, got up early, I'm dehydrated, too many energy drinks, too many coffees, not enough water. Yeah, I think I need to focus on my survival skills. and uh, and I'll let you go. It's 9 o'clock. The markets are going to be open in 30 minutes. I hope you know what you do. In fact, I hope you've already done your trades. I hope you're not waiting for the stock market to open to figure out what you do. I'm going to remind you every single day until you stop doing that kind of thing. I like to trade the London breakout strategy. I like people to make decisions first, and then I'll react to them, even though I don't understand their decision. No, no, no. I want you to be the boss. Yeah. And so really, you should have 3 or 4 or 5 trades in before 8 o'clock in the morning. And your real use of the New York Open, which is about to occur, is, are you going to hit your daily target, which will probably happen very early in the day? Or are you actually going to extend this out to a weekly target? It's harder to do this time of year. Not impossible, but harder to do. Typically, we don't have trends because of lack of trending data, but we do have a resumption of war, which is different. So the dollar could strengthen for as long as there's that conflict is back. Oil could go all the way back to $100 a barrel. No, not today, but it would take several days. But if we're back to war on, peace off, then that's the catalyst for a trend, not necessarily your normal macro trend, although it is macroeconomics, but it's a geopolitical change in market conditions, which can produce trends. So I want you to be focused on that, and but realize that you could have made some of these trades pre-London or pre-New York, waiting for New York to open and then do something makes you an observer, not really a participant. If you're a newer trader and you find that New York is tough because you make money for the first 2 hours and then it collapses and then you lose money for the next 2 hours. Well, what's actually happening is that people made the trades 3 or 4 hours before you even got to your charts. And they're taking profit because their day is over. Because don't look, especially Americanos, huh? If you're an American capitalist pig dog and you wake up, you're like, it's 9 o'clock in the morning and the markets close at 4. No, they don't. You're like, yeah, I Googled it. Stock market closes at 4. London closes at 11. And that's a huge part of the market, even for Americanos. It's a huge loss of capital flow. So if the game is over at 11, do you wait for 11 and then take profit? What if you've hit your target for the day and it's 10 o'clock in the morning? Especially if there's no news at 10. What if it's 9:45? There's no catalyst at 10, and you know you're done at 11, and you live in London and it's actually a sunny day and you want to go out to the pub early? Dude, you cash out and you walk. You leave. The day is over. And for a New Yorker, you're like, dude, that's 10:30 in the morning. The day is over for everybody else. So you shouldn't be starting your day at 10:30, right? You need to be lining up your trades at 6 o'clock in the morning and exiting when the market exits. Now, sometimes there's key important news at 10 o'clock. So people will hold on and say, well, I got to wait for ISM and then trade the vol and then, or capture the vol and then exit closer to the 11. Yeah. Now, if you were hanging with me 20 years ago as I was teaching this, you would know, or you would say to me, hey, Wayne, does that mean you start to take profit if there's news at 10:34? Yes. 10:35 is too late. As Biden would say, no joke. Yeah. So this is pretty cool stuff, guys. But don't wait for me to tell you what to do. That's not the point of these streams. I want you to ask questions so that you can become an independent trader, an advisor, so that you don't listen to some idiot on YouTube or reading the media getting generalized rules of thumb that are actually not true right now. You don't need that either. What you need is the truth. And you have it. You are the boss. So I want you to make the decisions. And then these meetings is when we talk about your decisions. And you refine your decision-making process. Right now, I've been focused on teaching you on asset selection, not trend development, not riding trends, asset selection. There's a reason for that. Because it's the right thing to learn this time of year. Peace on earth. May the pips be with you. May your profits be above average. DTFN, ta-ta for now.